Thank you so much for that. I've started recording the session. It's now recording. Okay, so for those who might join in later, they can easily follow through. Let me come back to where I was. So, like I was saying, I want to talk about the different products of investment, but for me, it starts from the investment strategy and also how it all goes into and encompasses what we end up having to do. So, in that, if you are on this call and when I'm talking to people and I'm doing their financial advisory, there are some things which are very critical for me to say before you deploy your money in anything, whether it's to start a business or whether it's to something that as simple as a unity trust, whether it's as simple as buying an endowment fund, the education endowment funds, which are Jubilee, Prudential, UAP, you have to take a step back and say, if I'm taking this, is it fitting into my overall strategy? Do I have the simplest of a strategy that is to say, I need to make these goals. I need to meet these goals from in 3 years, 5 years. These are the returns I need to make. Does it make sense for me? And someone help me mute. Does it make sense for me to how I'm deploying my money? And for you to do that, you cannot just talk about returns alone. You have to talk about the risks. And this is where we get it wrong. When we ask someone, when someone comes in and they say, oh, let's go do farming, someone has started green pepper farming, it makes money. No one tells you what it takes. They might tell you all the good things. Ask them, what are the risks I need to know? And then you look at that whole picture and say, is this within my whole investment strategy? What do you want to achieve? Because when you want to achieve something, then you're going to make more better decisions. And for example, if you are investing and you sit down and you are employed and you're trying to invest for 10 years, 20 years from now, there should be no way you should be doing something where you know the return is in 1-2 years. If you are going to go back to study in 1 year from now, you should not be buying a treasury bond for 10 years. You know why? It doesn't fit into your investment strategy. Returns, we're going to talk about returns. You must set your minimum return, and you say, if I can't get a 10%, for me 10% is my set goal, then I want to do that no matter what. And whether even if I see someone getting a 6% and they're telling me it's so good, my goal is 10%. We're going to talk about treasury bonds. You remind me to compare about Kenya versus Uganda, about the return perspective. It will become very good in there. Then you talk about liquidity versus wealth money assessment. Liquidity, you say, what are my liquidity needs? Many of us here might right now have a unit trust, which is literally the new bank account. The question becomes, if it's that liquid, how much money are you leaving on the table by having so much liquid assets versus wealth? When we talk about people who have so much land, especially the diaspora, I have 2 people from the diaspora on this call, who in the diaspora, what we do best is always to have a broker who you can trust to always skim around for plots of land. After 5-7 years, you find someone has so many of them, they cannot even track them down. And the question becomes, is that how you should be doing it? Which brings in the diversification. Have you taken a step back and say, maybe I'm holding too much of one thing over the other? Should I need to start investing in other products which you're going to look at? And then you have to review that whole performance. Now, to me, this is my 5-step process which I'm using when I'm developing my investment strategy for me or even for someone else, for different people. And it's something I recommend. Before you deploy money, or if you have already deployed money, you might have to be at step 4 that you might be like, do I need to diversify my investments? What do I need to do for me to diversify those investments? Do I need to reassess that I have too much liquid assets? People who have bank accounts. Charles, can you help me mute?
Bring my phone.
Perfect. Sorry, guys, for that. Chess is muted. So do you have so much liquidity? At any one point, do you have 10 million on your account that is just sitting there earning nothing? This is something you have to set up on the return, where you have to sit yourself down and say, I always want to make a 10% return per annum. Do you have a plot of land that you know you can almost predict in the next 5 years it's not going to grow, that it's time for you to dispose it off? So you have to take steps and accept to make that holistic assessment for all your investments. Even if it's business, you started a business, especially if it's for profit making. There are businesses we start for posturing, or you're trying to employ someone. But if you have started a business and you have noticed that in the last 2-3 years it has been struggling, maybe it made profits in the last 5 years, but it is struggling. You do not know where it is the future for it. You cannot explicitly define where it's going. Then the question becomes, might you be better off to reassess if it's really loss making and you do not see a realistic path for it to make money? Is it time for you to let it go? You know, so that's the question where you have to literally take a step and assess. Now we're going to talk about different products, but I developed them into two captions. We have the money market products and what we have the capital markets products or funds. You can, depending on what you want to do. Isaac, I'm still presenting. I hope others are still seeing it. You might want to drop off and join in or check the internet, but the presentation should be still on. But also, I'm recording this session. Just if you miss out at any one point, I think I will upload it even on YouTube later. If you miss out on anything, you can still come back to it. So, to me, the money market funds are those which are easily liquidable. That in a day you want to, you invest in a money market product for the full purpose that you can easily get some money in a few years, in less than 1 year, in less than 2 years, right? Yeah. Now someone will ask yourself, why did I put life and education policies in a money market fund? Money market funds do not so much build returns to a high level. The best money market fund right now we have in Uganda is unit trusts. And there are 6 right now. We expect 1 or 2. I'm told 1 or 2 are coming in the near future. But we have the Old Mutual. It's the biggest. It has close to, I think it's about to clock a 3 trillion fund. We have ICEA. It's around 440 billion. We have Sanlam 290, close to 300 billion. An article is coming about, and we're going to talk about Sanlam with what's going to happen with them when Standard Chartered goes. We have Zeno, Standard Chartered, Stanbic Bank Unit Trust, and Britam. All those are very good products, and that is the best product to start for anyone who's starting to invest, to product to start with. One, we always recommend someone to invest for emergency. Back in the days, the same word was that you should always have money for emergencies, whether emergencies for school fees, emergencies for medical, whatever emergency. But that meant that you had to have money on mobile money or on an account. You could find someone having almost 20 million on an account saying that's my emergency money. If you're a business person, you can sit there and say, oh, for my business, every time I might have an emergency for me to pay off something, oh, I have someone who is into real estate on the call who would say, oh, for my emergency is always I need to have money when I need to pay off a deal of a land. Now, instead of having that money sitting on an account, you put it in a unit trust. In some unit trusts right now, if you send a requisition for them to pay your money, you can get it in less than a day. And this is not to promote some of these, but that's the reality. If you bank with Stanbic Bank and you have a unit trust with SBG Securities, their standard unit trust, the commitment they have made, and so far I've tested it, is you can get your money in less than 4 hours from you submitting your requisition for your money, if you submit it less than before 1 p.m. So if at 1 p.m., by 4 p.m., you will have your money on your account. So then why should you, someone who is banking with Stanbic Bank, have money on your bank account? That's not to say you shouldn't have your money. You should have your money, which is expensing money, but not money that should be you need in like a month or 2 months. But at the same time, when you are investing, you should invest some money for emergency. Then treasury bills. Now, treasury bills are the simplest. You invest some money today, they tell you in 3 months, they will give you back all your money. However, because this is a full masterclass, I would say, it's good to learn about treasury bills. I would not necessarily advise someone to invest in the treasury bills. And the question is simple. Let me present it to you here. Okay, give me a minute. I need to raise some Excel I need. Why I wouldn't recommend. Now, it's good for me, I need to talk about them, but why I wouldn't recommend for you to invest in a treasury bill. So imagine, okay, let's use this. Imagine you have 10 million. I want to use 10 million here. Here. And this is treasury bills, how they are defined. They are defined in a rate that, for example, they give around 12% to 13%. But let's use 13%. The treasury bills in Uganda attract a withholding tax of 20%. So that means your 13% times 0.8 is what you remain with, is almost 10.4. So if you end up buying a treasury bill for 10 million and you hold that treasury bill for just 1 year, which will be the cutoff period, you would have made just 1,040,000. That same 10 million, if you give it to a unit trust and you give them a 10 million, unit trusts give around 11%, and they allow you to compound your money. Sorry. I'll come back to this later. You can see in a unit trust, you would have made 1.1 million. Now, someone can say, it's 60, 70,000 extra. But for a unit trust, you have access to your money anytime, whether it's after 2 months, after 3 months. For a treasury bill, you have to wait it to mature. If you don't wait it to mature and you have to sell it at any one point in time, you might lose some money. So it's important that, yes, actually, if you follow me, I barely write about treasury bills when Bank of Uganda and the Treasury are selling them, because I'm trying to make sure people do not buy them. Yes, they will give you a 13% return, which is more than 11% on a treasury, on a unit trust. But when you factor in the tax element, it makes the unit trust much, much better in the same period of time. So yes, it's good to learn about what treasury bills can do, but don't go for them. The only time treasury bills can be better is what we saw in Kenya when the treasury bills, like last year and early this year, when the treasury bills were bringing in more yields or more return than even the treasury bonds. They were bringing in around 16, 17% because government wanted a lot of money quickly. And what that did is that their return was high. But for now in Kampala, in Uganda, if you want to invest in something, a money market fund, don't go for a treasury bill. Then we have the life and education policies. Why would I put them in money market fund? Is for the same reason of their return they offer to their individuals. 10% is what you're going to get in a treasury bill. 11% is what you're going to get in a unit trust. An education policy, they offer a return of around 6-7%. They are not an investment element. They are a risk protecting product. So you have to understand that, and it goes back to your investment goals, that an education policy, you are not investing. You are insuring against a risk. That is an insurance policy. That's why for them, their goal is not to give you highest return. Their benefit comes in is to say, if something happens to you, you automatically have some money to fall back to. They will pay for that education for your child. So the question becomes, should you have an education policy? Yes and no. Yes, if you assess and say, okay, if something happens to me, my kids might not study, please buy that education policy. If you do not have assets that can easily educate your kids, have that education policy. Because when something happens to you, it will take care of you. But the problem is, people buy education policies for 3 years. You are 25 years, you are 30 years. You do not see any realistic part of anything that will injure your incomes. Or you are 40 years, you have enormous assets that are bringing in money. That even if God willing something happens to you, kids will be well taken care of. Maybe their mother or their father is aware they can have the capacity to educate them. Then do not buy an education policy. It's wastage of money. It's not an investment. It is a risk protection. But you have to assess and say, in your capacity, what is my risk? And then you go for it. Then we go to the capital markets, which are a little bit long term. We have fixed deposits. They were more common in the early years. Now, not so much because people have learned what it meant, but they are still a good product. For those of you who say, I do not want to take the risk of treasury bonds directly, I want someone else to take it. So you can go to Stanbic Bank, DFC, whichever bank. I know the best bank is NCBA right now. I think it gives around 13% net return on a fixed deposit of 3 years. But you must leave your money there for 3 good years. If you try to withdraw your money, there is a penalty to that. And another fixed deposit kind of product that the fund managers are bringing, it's only at Britam. Britam has a product which they are calling fixed income. It's a fixed deposit product where you go to them, you give them money for, let's say, 2-3 years. I think it starts from 1 year. They lock in a rate for you. As long as you know you will not need that money for maybe 1 year, they are good to lock in a 12% net return or 12.5. If you have to lock it in, the longer period you give them, the better rate they will give you. But you must see it through. You cannot withdraw that money. If you have to withdraw some of the money, there is a little bit of a penalty, but that's a good product for someone in the diaspora who is about to have an investment. You have some money, you might need it in 2 years, and you'll be like, it's better for me to invest it for 2 years without necessarily buying a long-term bond and without necessarily buying a unit trust that is going to give me 11%. So those fixed income products are actually a very good product because they are sitting at the intersection of a unit trust and a treasury bond. that for 2 years, 3 years, Britam can give you even 13%. Now, 13% compounded for 3 years, that's close to 50%. So if you give them 10 million, they will give you around 15 million. So depending on your circumstances, that would be a good thing. The second capital market product is rentals. Of course, I call it capital markets because it's long term. It's not a capital market, but rentals, yes, their yields are low, but over a long time, you can invest in them. Those ones I don't even need to talk about them. People most times understand them. Then we have exchange traded funds, the ETFs. ETFs can be either traded or over the counter. What the exchange traded funds are, it's a collective product that, how should I explain it? That tracks an underlying asset. For example, S&P 500, if you follow global stocks, or we can talk about the other ETFs we have, someone who invests in oil and gas in the Asia. So you do not, as Alex, you do not have the money or the capacity to go and invest in Asia oil and gas companies. So a company, the big global companies, they will set up an ETF. You buy into the ETF, and that money is used to invest in the oil and gas. For those in the diaspora, there is a client of mine who recently I told them, you want to invest in the Ugandan bonds, you don't want to invest in Uganda. You want to invest in Egyptian bonds, Ghanaian bonds, you don't need to go to buy them directly. You are in London. You can buy the Russell ETF. They have what they call the emerging bond market. It's one bond, one product that invests in around 8 or 9 different countries, Uganda inclusive, Egypt inclusive. And it's actually giving a higher rate. It's giving around 16, 17% return before management fees. But it invests in different countries for you, for that money, and for you just buy the ETF. In Uganda, the ETFs are just starting. I know just one company that has an ETF, but for them, it's not traded. They are over the counter. That means you buy directly from the fund manager. It's called Gold Catch. Now, I'm hesitant to directly say it out because for one reason, it's regulated by Capital Markets Authority. They have a license. I actually wrote about them. I'm about to write about them maybe this month, but they are fully regulated. I confirmed that with the Capital Markets Authority, the team there. They are investing in global stocks. They are trying to create that products for the global. That for those of you who know about Nvidia, you no longer need to worry that how do I take advantage of the growing Nvidia markets. For those who know about Teslas, so they have a good offering. They are dollar rated. You have to invest in the dollar capacity, but they have capacity to grow. They are the first exchange traded fund I know in Uganda that is fully regulated by Capital Markets Authority. There are others who will say, okay, we are doing this, but they don't. If I can't verify it, I can't speak about it because this is people's money. So Gold Catch is the only one which I know and which I've seen what they're trying to do. And I've seen for that 6 months when I've been researching about them, what they're investing in and the returns they are giving. So for those of you who are thinking about ETFs and you have some dollars to spare, Gold Catch is a good one to think through, and more articles are going to come about them. Then stocks and equities, they are very good. If you're in Kampala right now, I would tell you it's time to start buying some stocks, equities. But I'm not going to tell you to put 50% of your income, your money into stocks. Stocks is something you buy slowly but sure. Every month, you can spare 200,000 and buy some shares. There are companies where, for right now, we know they are sure bets. Not because we are betting, but because they are profit-making. MTN, it's a profit-making company. Chances are right now, half of us have MTN line. Stanbic Bank. If you are a Stanbic Holding, if you're a Stanbic Bank customer, you trust them to bank for your money, you can as well be a shareholder. Their share price has been going up and about. That's a company that makes over 500 billion in profit almost every year. I think 400, 500 billion. They pay dividend every single year. Airtel, the price is going down, but it's good still to buy. Why? It's a profit company that is paying a dividend every single year. Baroda. That company is, we are sleeping on it. Their share price has been consistent going up for the last 4 or 5 years. So for you in your capacity, PFCU, their price fell down after that Crane Bank saga for 3 years. It took it down, the legal battles. They have changed the leadership. They have brought in someone exceptional. They have undercut costs. That bank is about to come back. It's about to come back strong. It's one of those companies I tell people, we are sleeping on it. This company is making close to 60, 80 billion. Banks, actually, let me say, banks are profitable. They will make money, they will pay dividend. Those are the stocks you want to buy. Don't buy New Vision. Sometimes I wish government stops funding it and it lets it down. Go and buy stocks which you know they do extremely matter. So if you're on this call and you're asking yourself, I had never paid attention to it, I usually say, think about it from this angle that how much money do you spend on simple expenses, or how much money, if you are to lose it in a month, it won't pay you. Maybe it's just 50,000. Yeah, it's 50,000. That's the money you need to monthly buy stocks. Stocks you don't need to go and buy get 50 million at once and go and buy. No, you might not need to do that. But that 50,000 every single month, you do it for, let's say, 10 years. In 10 years, you will look back and be like, thank God I was throwing away 50,000 for this. Stocks is the future. Now, then, brings back to the Treasury bond. Right now in Uganda, one of the best products you can invest in. Before I go to the Treasury bonds, I'll pause for a minute to see if anyone has a question before I continue. Any question? Hope they are not in the chat because I'm presenting. I wouldn't see it.
I had a question.
Yes, please.
Maybe you threw a small shade of light on ETFs. Perhaps I wanted you to clarify more on it. Maybe how does it look like? Maybe since it's a new product coming in Uganda, how does it look like? Maybe in the next 1 year, how do you see how it's going to be? Then on stocks and equities, let's say I want to buy shares. Before I go into what factors do I consider before I go into the share to buy shares? Let's say MTN, Stanbic, Bank of Baroda. Like, how do I follow up? How do I have to look into the performance before, and like how do I come to a decision like this would be a good stock to buy?
Okay. Thank you so much for that. I'm presenting my trading platform, like things where I monitor my markets, just for demonstrating about ETFs and giving it a little bit of more weight. iShare, it's one of the best index ETF you can ever buy. For those of you who have capacity to buy from global markets, right? ETFs, you buying an iShare, let's say this is iShare Core S&P 500 ETF. This is what you are investing in. But they invest in the S&P 500. So an ETF, you are buying into a product whose underlying investments is something else that you don't want to directly go into exposure with. And they are very, very common. And you can see here they're telling you the underlying index include approximately 86.4 of the market capitalization of the publicly traded US equity securities. They are very, very good. ETFs is actually there. Sometimes they say you can more, you have a higher chance of making more money through ETFs than through directly investing. So if you want to buy, you might not have enough money to buy Nvidia, to buy Tesla, to buy Apple, to buy Amazon, to buy Meta, but you can just buy one ETF that buys into all of them, that whatever, every time those companies go up, they go up. Now, in Uganda, the one which I know, which I can say it's purely an ETF, is the Gold Catch. They invest in the global stocks. I'll put their contact, their website, and you can check it out. The fact that I always say in Kenya, they have more. I always say we are always 4 to 5 years behind Kenya. Whatever is happening in Kenya, so whatever they are going through right now, we might go through it between 2028 to 2030. But I expect now there is more awareness in investments and trading, and people wanting to have more products and more of where they need to deploy their money, that fund managers are starting to be more creative. I would expect more ETFs to come through, especially the big fund managers. There is no way I see Old Mutual, Stanbic, SBG Securities, Britam, Sanlams, with the capacity and the assets they are sitting on to be comfortable to remain in unit trusts alone. They need to start becoming creative. So ETFs are going to come like that. Someone can even argue that they already there because, for example, like Old Mutual or even Zeno. Zeno has what they call regional equities unit trust. When you invest in that, you are deliberately investing in stocks. So you are not going to go and buy MTN shares, but you're going to buy Zeno shares, Zeno units, and that money is used to buy the MTN, Airtel unit, whichever. So the future of them is coming. If you can invest outside, take advantage of them. If you in Uganda, it's still one, you can be a little bit conservative on them, but it's also okay to start learning what they are. You know, you can start learning what they are and start seeing how they are performing. From this, if for those of you who are seeing, if I'm to can see how it has been performing. They are tracking it for you for the last 6 months. But even if we are to take it for 3 years, you can see at one point it will go down. So the question is, when does it go down? Depending on the underlying assets it has invested in. If they go down, it also goes down. But you can see people who invested in it in 2022 have been on a high trajectory for the last 3 years. And that's the benefit of the ETFs. So in Uganda, it's only one. They are over the counter. You have to go to their office. They will show you their products. They are fully regulated. And then you talk to them and see how best to take advantage of them. Then someone asked, do you think the Stanbic stock price will grow now that Standard Chartered is pulling out? The capacity for Stanbic stock price to continue growing are two best for me. The brand is getting more recognized. It's the biggest bank. This is a 90 trillion asset company. It's making over 500 billion in profits and it's giving a dividend. So that means the demand for such a stock will always keep being high. So the more the demand, the higher the price will always go up. So you might as well enter now. Stanbic is not about to go anywhere. If the price right now is around 55 shillings per share, be sure that in 2 years from now, it might be around 60 and above. But also you're going to be making money every now and then. I think it pays a dividend every 6 months. So you get some dividend as the price goes up, right? So yes, that's how it's going to be. It's how the performance of the company is and how the growth of the brand and the demand. Then in the case one wanted to invest in ETFs such as the S&P, how would you best advise them to do so? Is it viable? Conrad, S&P 500 is one of the most viable. Most of them are driven around here, right? You can, let me see. This one. Okay, Islamic finance overview. Most of the companies which are pricing their ETFs around S&P 500, they are making money. They are growing exponential. From a viability, yes. From being in Uganda, if you're in Uganda or you want to invest in them, I don't know. There is no way. I've looked for it. They have not yet opened them except up. But maybe one of the fund managers will soon give us that option. Even the one with the gold catch, which I'm talking about, they do not bring the S&P 500. So no, not yet. Judy is asking, where can I get information about the performance of the various unit trusts? Judy, I write about them. You can go to their websites directly. You have to go to the 6 websites. The other way is I try to write about them at least every month to show which companies are doing much better. But from a performance perspective, they are the same. Let me just say similar, not the same. I think they all offer around 11% to 11.75%. The question of you, which brand would you go for? It's going to go back to other convenience. Convenience of technology, convenience of which bank you have to bank with, convenience of do you know who someone who's going to do what, convenience of who your friend is going to recommend Old Mutual, Sanlam, Britam, SBG. I recommend all of them. I have 4, I think actually 5 now. That I'm in all 5 of them. I think it's one to go, which I should also be trying to join soon. But why am I in all of them? First of all, for information, because I'm in all of them, they must send me information as an investor. But 2, diversity. It's not that I know they are investing in the same products, but it's okay for me to have Old Mutual, to have ICEA, to have Sanlam, to have even Zeno. Why? Because there I can easily compare every single month and I know who's doing what. And what I've done it is in such a way that, which I would actually recommend Judy, is to say, you can have 2. Both of them give them the same money, the same amount of money for like 3 months consistently. After 3 months, you're going to say, which one is giving you more profits? Now that's one which you should start giving more money, because it starts to compound faster. You don't want one to give you 11% consistently as the other is giving you 11.4. Now that is 0.4% might seem small, but as time starts to compound, it starts to grow. So, but they are all the same. It's the convenience that comes with them. For those of you who are in Standard Chartered Bank, have enjoyed the shilling, you literally just create a standing order and money keeps just getting off, and they go to the invest in their Sanlam, and you're getting a very good return. You know? Okay.
Can I interject a bit?
Yes, please.
What's the average interest rate on EFTs, like ETFs? I'm inquisitive about them. Maybe I'll ask you more after this lecture.
Depending. Now, let me put it this way, without trying to set the tone of your expectation. When markets are doing extremely well, ETFs can even return at 20% per year. And that's what is happening right now. So you can go, in Kenya, there's an ETF which right now is almost doing an aggressive promotion. It invests in the global stocks, and now it's returning a 16, 17%, and it's almost every single day it's promoting on Twitter. It's not because of the ingenuity of investors, it's because of the ingenuity of the stocks they're investing in. You should be expectant that if the stocks they are to dip, your investments will also dip. But they are good way to hedge, because most times if they're investing in like 20 or 30 companies, if 2 or 3 companies are struggling, 4 are doing better, 2 are just like they are just living their life, they average it out and they'll give you 6%. For me, I always, for my investments in the dollar investments, I always say, if it's a dollar investment, for as long as it can guarantee me a minimum 6%, I'm good to go. Some of those ETFs, so if you go to, let's say, Gold Catch, they're going to maybe present to you a 10, 11, 12% gold dollar return. You have to sit back and say, okay, what products are you investing in? How have they been doing? That they have been doing like this. So that means that's why your ETF is growing. So you have to have an anticipation of the risk that if those products were to dip in prices, then my investment will also dip. But generally, they perform very well, especially global ETFs.
Oh, and lastly, do you anticipate maybe Ugandans to be able to invest like directly, buying directly? Maybe is there like a channel to be able to buy the ETFs directly? Like I don't need a hedge fund. I can buy directly S&P 500 from the global markets.
Yes, the question is where. Now, I work in the finance. I'm in Bermuda. Bermuda, it kind of gives you an exposure on how the global markets see small countries. It's about risk of money. Or we can easily download a WhatsApp app on Google, Google Store, Apple Store, download Meta, all these different big apps. But somehow, if right now I'm to tell you in Uganda to search for Robinhood, you won't see it. Or eToro. Why? To them, they are saying, no, I do not trust. Not that they do not want your money. They cannot easily verify the person in Kampala to the extent that can pass the scrutiny test of SEC. So the biggest limitation for us in Uganda on why we cannot indirectly invest in the global stocks and the global ETFs is that the conveyors that would enable us to invest in them are yet to accept Africa at large, actually. I think it's only in South Africa where they are starting to allow. So they need, because our country is still a high-risk country when it comes to money laundering, they do not, the risk of them assessing Kakande for you as a Kakande and you deploy your money in the US market in a way that they can verify you is still very hard. So that's why they just blacklist us. But someone in the Europe can, someone in Dubai can, because they believe, okay, even in Dubai there is limitations. But the question, will we be, maybe as the global scale improves, I know right now the Bank of Uganda is trying to do as much as possible to improve Uganda's capacity in global anti-money laundering. They don't even want your corrupt money. Now, they do not know, Kakande, you have 100 million. Where are you getting it from? Can they verify that it's not corrupt money for them to allow it to bring that money into the global market? So those are the limitations. They are structural limitations as a country, not to you or me as an investor. There is limitations that would, it's just an app. But for them, because they know they cannot verify your KYC, they are limiting you. So the only way is it's going to be big fund managers who are going to set up shop in Uganda, take the risk to verify you, do more scrutiny to get your money and invest on your behalf. That's the future, and that's what is happening in Kenya. Simon, of the bond, I'm going to talk about the bond. I jumped to the bond. I know it's when you go into the bonds, we can easily forget to talk about the other products, which are very important. So going to the bonds.
One more last question.
Yes.
On the stocks and equities, I'd asked like how you come up to the decision that, like, how do you determine, like, let me buy these shares and they are going to maybe grow in 1 year, 2 years? Do you look at performance? Do you look at I don't know, how do you come up, like, I'm going to buy Stanbic shares, I'm going to buy MTN shares? How?
Yeah. Let me answer that question in partnership with what Rena has typed. Let me use the best example, Cipla in 2018. Cipla gets listed in 2018 at 262. If my memory serves me right, almost all of us independent, by then I was very, very small. I remember I used to have like 500 followers on Twitter, and I used to make a lot of noise. Guys, do not buy Cipla. Something is not right. They were valuing that company at 1 trillion, and we said there is no way that company is valued at 1 trillion. The fundamentals were not adding up. One, they were still enjoying the tax holiday. Two, the money they were about to raise were exit, like the shareholders to get money and move. Three, Uganda it needed so much money to list. So somehow, somewhere, the regulators needed to do enough scrutiny on the price they had put. But people were like, let's buy. In less than 1 year, the price had gone for a half. But most of us foresaw it and we didn't invest. Now it's at $50. The value of the company is around 200 billion. Now that's a valuable company. That's a worth of value for that company. It was never a trillion company. It was not making a profit. It was still enjoying tax holidays. It had a lot of receivables from Zambia and Rwanda and Uganda. Now where it is, the fundamentals make sense for someone to buy. Which says, so what do you need to look out for? Like what Rena talked about. Sometimes our regulators don't do a good job to underwrite these companies. We are so much in demand of companies that we want companies to list that we do not scrutinize them very well. You have to take a step back and say, if I'm buying the shares, can I look at this company? What is its value? Even on Airtel, we questioned them, we told them, I remember when I was on a space, we said, you're valuing your company at 4 trillion UGX. It makes no sense for your company to be 4 trillion when MTN with its mobile money is 3.8. That's why when NSSF came, it said, okay, I need a discount of 50%. And they had to give it to them, others that IPO would have failed. And if it had failed, it would have even been more disastrous. So you have to look at those fundamentals. And if you can't, if you do not have the capacity to analyze them in that full detail, then what you should be doing should be buy already established companies. Established companies, you already know that the assessment, they have stabilized, the assessment has already gone on. Now that underlying risk is already out. When you're buying Stanbic, it has already gone through the dips and ups. Now it is stable. If you're buying Equity Bank, it has gone through its ups and downs. It's now stable. If you are buying Baroda, it has been listed for 10, 15 years. But for me, the only companies I always tell people to buy, especially in the Ugandan context, are companies that pay dividend. At least if a company's price is going down, but they're paying you a dividend, you're getting your money back. In 5, 6 years, you can get your money out. And when you sell after that, you're getting the profits out and move. We do not have the luxury of buying stocks which they are not paying a dividend. That's growth stocks. Those ones, we leave them for the US, not in Uganda. Of the 50K monthly investment in stocks, I do not want you to get 20 million and go buy MTN shares. Because if the price falls right now, you're going to get a hit right away and you will feel it in the stomach. But I'm happy for you to say, and I quote, that 100,000 is not so much money for me. Either way, if I go out for an enjoyment, it's the money I'm going to spend. So I can dedicatively buy 100,000 every single month for the next 20 to 5 years. After 5 years, you'd have deployed over 10 million, but in a way that is systematically doesn't impact you and it doesn't make you feel the pain. It's like paying school fees. Like every single month, I would say, it's a strategy, it's an investment strategy that every single time you are paid or you get an income, take off 100,000, 200,000, 300,000. Do not take off all of it and buy stocks. Just something that won't pay you even if the stock goes down, and just keep buying for the longest period possible. Going to treasury bonds. Let me start from here. Right now, in Uganda, there are very, very few things you can do from an investment perspective that can guarantee you at least a 15%, 14%, 13% return per annum, like treasury bonds are doing. The recent auction brought in a 17.5%. We last saw that in 2-3 years ago. And the question you're going to ask yourself, how come the rates are going up? The government is desperate. It's looking for money. So the more money they need, the more the competitive price will always go up. A 17.5, it meant that people get a 14% discount on the treasury bond. So for someone who bought it was this. Okay, let's not be seeing it. That's better? Is that visible enough? Because I'm going to explain this, what treasury bonds are and how it is. Okay. This is what happened this week. And for those of you who want to literally understand what treasury bonds are, every single day, government needs money to survive. If you are on this call and you're employed by government, your salaries, roads, everything that you might think of. And there are two ways government can raise money, like all of us, from tax and non-tax revenue and borrowing. They no longer get so much free money. The grants have literally dried down. And we know the limitation to our taxes. You cannot tax us too much. There is so much you can tax Ugandans right now. So they have reverted to borrowing. And we're going to talk about the risks in a minute, what that means. The budget that was passed was a 72 trillion budget, which was reduced to around 60 trillion. But we're going to wait when they pass supplementary budget. Half of this budget is going to be funded by borrowing. And that borrowing is from local market, which is the treasury bonds. Last year, financial year 2023-2024, the government borrowed from treasury bonds and treasury bills a total of around 15 trillion in one single year, financial year. Right now, we are in November. 5 months in, July, August, September, October. 5 months in, it has so far borrowed 10 trillion. I have 7 months to go in the financial year. So there is a little bit of aggressiveness to get money. And that is why you are seeing interest rates going up. So what ended up happening is that if you had, let's use 10 million, which is easy, 10 million, and you wanted a bond of 10 million, you only paid 9.2 million. So right away, you made a profit or a discount of 700K. Actually, it's close to 800. And if indeed you wanted to also deploy this, so that you spend 10 million, that means you would have got a bond of 10 million and 900, and you would have spent your 10 million. Still, you would have got a discount of 800K. Why are you getting a discount? The government wants your money so much, it's willing to let you retain some money for you to get the money they need to get. But that's not all. Because this bond, the 20-year bond, is paying a coupon on 9th January 2025, which, if we are to say, they are 40 days from now, it means you are buying a bond that is about to pay a coupon. So you got a discount of 800K, and you're about to get a 700K here. So in just a space of 40 days, you're going to, from your 10 million, you're going to make a profit of 1.6 million. That's why we have an interest rate of 17.5. So when you're buying bonds, the best thing to learn about treasury bonds are 3 things. What are you trying to invest for? If you have capacity to invest for long term, 10 years, 15 years, 20 years, always buy those bonds, because one, they most times come at a discount. And I've demonstrated to you a discount. A discount means the money you spend will bring you a higher bond. That if someone had 100 million, they would have gotten over 90 million more. You know that thing, to whom much is given, to that who has much more is given to them. If someone had a 200 million, $18 million more right away. And then they would start getting 14 million in 14 days from now, 40 days from now. Right away after Christmas and after New Year's, you start getting your 14 million. So a guarantee of that investment, there are things you can do that can make that money, but there are not so many. And there are not so many for many of us who are either salaried or our incomes are not expansive. And that's what makes treasury bonds one of the best products right now. The biggest risk on treasury bond is not inflation, like what people tend to say. No, not at all. Why? The inflation in Uganda is around 3-5%. If you are going to get a bond, a rate of 17.5, even if you take off a 5% interest rate, you are getting a net return of 12%. That's one way to look at it. The second way to look at it is inflation impacts everything you can ever invest in. Whether you invest in unit trust, you invest in rentals, you invest in business, farming, whatsoever. Why? Because inflation means if you have 1 million today, how much will it be in 1 year from now? It doesn't mean if you have 1 million of bonds or 1 million of rent. It's if you have 1 million today, how much will it be? What? Tomorrow. That if right now it can buy 10 bags of sugar, in 1 year it will buy 9 bags of sugar. That's what inflation means. So if you 1 million, you're getting it in rent, that 1 million will buy you 10 bags of sugar. In 1 year, it will buy you 9 bags of sugar. Inflation eats away that. If your 1 million is, you're getting it from business, it is buying 10 bags of sugar today, 9 bags of sugar a year from now. If you're getting it as salary, salary is the biggest inflation eating capacity. That if you're getting 1 million today in rent, in salary, and your rent is, you're paying, the cost of your living is, it takes 900K, in 1 year, it's going to take the whole 1 million. Inflation has eaten away the saving capacity. So in the treasury bonds, how I bring it out better is to say, always buy bonds whose rate is way above the inflation. That I know, if I deploy, let's go back to the easy to track money. 100 million. With 100 million today, I'm going to get 109 worth of bonds. So we are in November. Okay, today 30th, we are almost December. This bond is going to give me 7 million in Jan. Then it will give me another 7 million in July. Then it will give me another 7 million in January 2026. So in a space of 13 months, I have 22 million. But I still have my 109 bond. So it means if I just keep that investment in one place, I have 131 million. Now, the question you have to ask yourself from an inflation perspective, which I'm trying to explain, is what can 100 million do for me right now? 131 million do it for me in 12 months from now? And if the answer is yes, you're protected against the inflation, and of which bonds do. So then that's the first risk. That for as long as interest rates are high, you are good to go. The second risk, which is we call remote. Treasury bonds are lending to government. Counterparty. Because you are lending money to government, it can default. That's the biggest risk. Has it ever defaulted? No. The government started issuing treasury bonds and treasury bills in Uganda in 1969. Ever since then, they have never for a minute defaulted, not on coupon payments, not on rate of principal. In this November we have ended alone, the government has paid out over 1 trillion in treasury bond coupons and treasury bills. 1 trillion. It's actually super amount that they would rather delay paying salaries or deploying in medical interns or whichever priorities which we sometimes think they are priorities, but they pay coupons and they pay bonds and bills. Why? The foundation of our financial system in Uganda is sitting on treasury bonds. Now, it's not easy to hear that, especially if you are skeptical about this. The foundation of our financial sector is sitting on treasury bonds by 3 ways. The biggest company in Uganda is NSSF. it has close to 12 trillion or 13 trillion in treasury bonds of the government. That if government is to wake up and say we are not paying a treasury bond, I assure you, for all of us who have treasury unit, who have NSSF money, we have no money. It's a bust, gone. That's how big it can be. The biggest industry in Uganda is the banking industry. It's a 40 trillion industry. They have 20 trillion of that money in the treasury bonds and the treasury bills. It's you and I deposits, our deposits. Half of that money is in the treasury bonds, 40% of that money is in loans. That if tomorrow the banks are to wake up and government refuses to pay banks their money, no bank will survive, not even a Stanbic Bank. Stanbic Bank has around why am I talking about it? You can find it. I think it has around 90 trillion in assets. Half of them is in the treasury bonds. So if government is refused, if it was to refuse to pay Stanbic bonds, automatically Stanbic has no money. If half of the clients of Stanbic Bank are to say we need our money in cash, that bank can easily close. Why? The money is in bonds and in loans. So the third biggest industry in Uganda is the insurance industry. They have almost all their money in treasury bonds and treasury bills. Then you come to unit trust. Then you come to MDIs. What am I coming at is that if you are looking at all the biggest brands, they are sitting on treasury bonds. The government understands you cannot fail to pay them. To do that, you are creating a catastrophic impact that no one would easily recover from. So what do? You have to pay. That's why they have never failed to pay. Not even anywhere. And I'm going to talk about Kenya for a moment. The question is, people have heard about treasury bonds have failed to pay. No, they are not treasury bonds. Those are what we call Euro bonds. What happened in Ghana? Now, what is the difference between a Euro bond and a treasury bond? A treasury bond is issued in the country's currency. For example, UGX, Kenya shillings, Tanzanian shillings, Rwandan francs, Ghanaian cedis, like that. A Euro bond, however, is issued in the dollars. The risk with issuing something in the dollar is you must earn that dollar. UGX, they can print. Oh, no, not even print. When it comes to treasury bonds, they don't print. When one bond is about to expire and they do not have the money right away to pay it, they issue another long-term bond. There is always the Kakandes and the banks willing to buy. It's like a conveyor belt. The Euro bonds, you can't. There are limitations to it. You do not have control over that system. So that's why the tools the governments have on their currency allow them not to borrow, allow them not to default. That's why they say globally, treasury bonds have never defaulted in any country. They are the safest investment you can ever make. In Kenya last year, there was a discussion, an anticipation that for a moment, the government might default on Euro bond. It had got a Euro bond, which matured in this year, 2024. And it was creating a lot of uncertainty. What the government did, it had to go to IMF to borrow more money in dollars to pay the euro bond. Yet when it comes to treasury bonds, they just keep recycling it back and back and back. And that uncertainty, why in Jan, Feb, March, the Kenyan bonds were offering almost 18% and above. 18% means you're going to double your money in 3-4 years. The rates right now are going down. They are back to 15. Actually, now the Ugandan bonds have taken over the Kenyan bond. But that tells you the security that comes with the treasury bonds. These are Stanbic bank accounts, financial statements for this year, for 2023. They haven't released it for 2024. You can see the treasury bonds and the bills are the trading, the line called the trading asset, for those of you who can see it, and the financial asset. Between these two is close to 3 trillion. So when you come down and look at deposits, customers' deposits are around 6 trillion, 3 trillion is in treasury bonds. Half of your deposits are in the treasury bonds. So the government understands, and the people at Bank of Uganda, they are highly competent technical people, that they cannot let that ship get off the rail. The repercussion to all of us will be dire. So the biggest protection is that the closest it can come to becoming diabolical, that we can, government or Bank of Uganda will not pay you, is in political insecurity, where it becomes unattainable. But even in 1979, and I was doing some research and I going back into, because in Uganda we can relate, Amini offered bonds, even in that transition of Amini, the chaos up to 1981, or even 86 and 87, the government paid treasury bonds to the dot. So it knew, even those people who were in there, the technical guys, they knew even no matter who is in the government, they needed the money. There were no taxes, no money. So the only way for them to continue doing is to continue borrowing and paying the people they are borrowing from. So they never defaulted. So that gives you a bit of strength. A country like Sudan right now is going through war. The holders of treasury bonds are still being paid. They delayed for payment for close to 3 months, and they stabilized. Now they are paying them. Now, does that mean that you can never default completely? I cannot say that, but it gives you the assurance on what it can be. So then, why then should you invest treasury bonds? It brings. Someone asked the question. Okay, Joshua, let me come back to that. Okay, let me first address that. Yield to maturity, look at it as interest rate. The difference between yield to maturity or interest rate versus coupon, this one, if I'm to type it, never changes for the life of a bond. It will, if the bond, its coupon is 15%, it will forever be 15%. It's what determines the cash flows and then what you get at the end of every single 6 months. Yield to maturity or interest rate is the prevailing pricing. Now, when people look at bonds, they will look at this price here, the 92, that, oh, I paid 9, or I paid 100 million. What determined that 100 million is what they call the yield to maturity or the interest rate. So at any one point, you want the interest rate to be higher. Never worry about the coupon rate. The coupon rate can even be for 10%. But interest, for as long as interest rate is 16%, you are making money. If the coupon rate can be 18, interest rate is 13, you are losing money. You can see for the same bond you are paying 154 million. So you're losing over 50 million. But yet, if this one is, we change it, for 100 million, you're paying 85 million. So where do you want to be, Joshua? You want to be for as long as the interest rate or yield to maturity is high, you are making money. That is the pricing rate. It's the pricing factor. It's what determines what you actually end up paying. So you want it to be as high as possible. Perfect. So going back to that was Simon who asked about it. Compounding of treasury bond. The best way to take advantage of treasury bonds, you have to learn to compound them. That's the only way to make more money out of it. So I know some people have been dropping off and on. So you sit back and ask yourself, how much do you want to start with? All of us can start with however much money we need. However much money you need. Let's assume you have 10 million right now. But you know every single month you can access a 300,000. You just keep buying. $10 million, you just buy the 10 million. Then every single month you get a 3 million, a 300K, you keep buying a treasury bond. The minimum amount to buy a treasury bond is 100K. So it means for you who can access a 300K, just keep going and buying. Close out the noise. Set your target. I have a client of mine here who's, I think, 27 or 28. Very ambitious from when it comes to money matters. And I know she tries her best. Every single time she's in my inbox, what do I do with this? What do I need to do this? Investment club, this, would they work? And I say, have goals that are longer than you. At 28, you can easily say, I want to do it until when I'm 48. There are people who are right now at 48, they are saying, wait a minute, I wish I knew this when I was 25. They think they would be far. And I tell them, you are 48. There is someone who is learning about treasury bond at 65, and they wish they knew about it at 45 where you are. So start. You are 65. Do not worry. Start. I've managed to onboard my mom at 63 to start investing in unit trust. And it took me almost a year of me convincing her, stop preaching me about land here, land plot here. Try also my product. Now she's in it, she's happy. And if God gives her a little bit longer life and she does it for 7 years, she's going to build a nest. So it doesn't matter where you are. But the earlier you start, the better. So you have a 10 million here. And you keep doing just 300K. In 10 years, you'll have around 100, close to 100 million. And I'm using 12%. But in the last 25 years, the treasury bonds have given a minimum return, net return of 14%. That if I'm to put here 14%, you can see the numbers change automatically. So if you are 30 and you start right now and you live a long life, by the time you are 45, you just start with 10 million and consistently remain at 300,000. In 15 years from now, when you are 45, you'll have around 45 million. If you have a little bit more money and you start with 100 million and you can raise maybe this to 1 million per month, oh, you are in money. In just 15 years, you will have 1 billion. Now, sometimes people say, but what will the value of that be in 10 years? Yes. Let's assume you started in 2010. Or let's assume you know someone, yourself or your father or someone who could do this in 2010. We are in 2025. If they did this in 2025, they would be having around 1.4 billion and earning close to 173 million per year in income. Yet if you constructed rentals here with your 100 million, I don't think those rentals would be giving you that value. 100 million worth money you can construct in rentals, a minimum they can give you a year is 5 million. 100 million is giving you 14 million per year net return. %. So you can see. So then you sit back and say, it goes back to the investment strategy. There's a client of mine here who was on this call who I talked to, like I think 2-3 weeks ago. They have a young family. I have young kids. And when you sit about kids, you know, in 15 years from now, they are going to go to university. Some of you of us, we are starting to dream that I wouldn't want my kids to go to Jambo, go Makerere. At worst, let them go to Strathmore in Kenya. If I have some money, they should go to South Africa. And if I have more money, they should go to Australia, UK, whatsoever. Then you're like, what do I need to do to establish an education fund that I know in 15 years from now, I would need a 100 million to pay for university. What do you do in that regard? You say, right now I have a 20 million. Okay. And every month I can do a 500K dedicated for my kids' education. That by when the time that you go to university in 2035 or whichever, you will have established around a 200 million from a 20 million and a commitment of 500K in that investment. That's the power of compound. You must see it through. And the good thing right now, the rates in the treasury bonds are still too good that your money doubles almost every 5 years. So it doesn't matter. Right now, I have people who can do 100 million on this call, and I have people who can do just 100K. Even if you just start with 3 million, let me say 2 million, and your capacity is 100,000 a month. You dedicatively put there 100,000 per month and do it for 10 years, 15. One day you're going to hit 100 million. The fact that you are starting with less money, you have a chance to hit 100 million. You'll hit it and be like, my God. You see? In the 60th year, the revenue you are making is more than the contribution you are making per month or per year. Why not take advantage of it when it's still lucrative, given the risks are that minimum? Starting to take questions on the bonds. I'll start with the Rena. Automatic rollovers. No. And I would never say for you to do it that way. You still have to, every time you have money, you still have to go to the bank and fill up the form. But its technology is coming. There is, I was talking to Bank of Uganda. I think early next year they are launching where you can invest using a website, and on the web portal, just log in and invest. Those bonds change every single month. You don't want to do a rollover because someone will choose for your bond you don't have to choose for yourself. But it takes them 2 minutes, even if you're filling up a form. Yes, in 1 month you might forget, but you won't forget in 2 months. If you have a 100K per month and you forget to do it in Jan, in February you remember, now in February you have 200K. Fill up that form and take it to the bank. But when the app comes, the paperwork is so demanding. Fill up and the technology will simplify this. 2, and what is very important is you can easily say, talk to your bank to give you what they call email indemnity. Where you no longer need to go to the bank. You fill up the form, scan it, and send it to them. They know they will invest for you. How do I track the bonds?
Alex.
Yes, please.
I have a follow-on question to your response to my first question. When we are reinvesting the interest or making additional monthly investments, does it have to be that specific bond? Because I could have 2 20-year bonds or 1 20-year bond and a 25-year bond, for instance, and both of them have different returns. So,
okay.
Yeah, can you shed more light from that perspective? Would I be putting the money, investing additional funds within just those 2 bonds where I've already invested, or would I be starting a new one which has a higher return? I'm just trying to understand the reinvestment and how to benefit from it, maximize the benefit.
Thank you so much. The answer to that is going to answer for you, Innocent, your question of bond laundering. One, let's take a step back on something we started with, the investment strategy. There are people who are going to come to you and they say, my strategy is to maximize return for the next 10 years of 20 years. That means every single time you're buying a bond, buy a bond that, what's the word to say? Buy a bond that automatically will always have the highest return. Most times it's just one bond. In the space of 2 years, it is going to be just one bond. Right now, it's that 20-year bond. For the next 1 to 2 years, it's going to be that one. So if your goal is to maximize, squeeze out as much profit as possible, apologies for using the word squeezing out, but it kind of brings the point back home better. Then every time you are buying, just buy that. Until one day another bond comes and takes it over. Then you move to another. You have to study the market. Another one is going to tell you, I want to invest in the bonds in such a way that they bring in money every single 3 months. So a bond pays twice a year. The 20-year bond pays in Jan and July. Then you're like, I would want to have a bond that pays me in March and July and September. Then you go in and look for that exact bond in such a way that you have 2 bonds, one pays you in Jan, one pays you in March, another pays you in July, another pays you in September. So your goal was to structure your investments that can bring in cash flows in different months. So what that means is, whenever you're buying a bond, you're going to sit back and ask yourself, when do I get the money? So let me buy one bond A, next month let me buy bond B, the other month let me buy bond C. At one point you're going to wake up and you have like 6 bonds and they are bringing in money every single month. And it will automatically ladder you. But to ladder yourself, you can easily say, I want a bond that is going to mature in 5 years. You buy that. You say, I want to go have a bond that's going to mature in 10 years. You buy that. I want a bond that's going to mature in 15 years. You buy that in 20 years because you're like, laddering is the same way. A dollar. Apologies for guys. It's it's the stairs. Like, so you buy bonds that mature at different intervals. You automatically make it your goal to not buy one bond, but buy like 10, 15, 20 bonds that almost every 2 years there is a bond that is going to mature and it gives you some money. You eat that or you do it with something else every 2 years. Like it's an amazing journey when you start with it. Really, really good. So you do it deliberately and intentionally. The question what that means is you might have to leave some money on the table. Then your goal is not to maximize profit. Your goal is to stagger your cash flows in such a way that a 5-year bond is going to give you a profit of 15%. A 20-year bond is going to give you a profit of 17%. But because your goal is to land a treasury bond, you must buy a 5-year bond because you already have a 20-year bond. Even when you know the 5-year bond has a lower profit margin than a 20-year bond. Right? So you automatically drive it because of your investment goal and say, because I've decided to make sure I have different bonds that mature over time, and automatically you will have bonds that have different interest rates. Someone asked the question, I think I've jumped out. Let me come back to that, Fiona. Someone asked a question. Give me a second. I say that I don't forget them. I wanted to present this bond because it's long term. It's okay. It go down. This is a good bond to show you how bonds work. That when it first came out in 2018, it was at around 15. It went down to 14%. It goes back to around 17. We enter into the election period, it's around 16. After the election period, it goes to 18.5. It goes down to around 16. It's now stabilized around 16. So when you're thinking about interest rates, they change. So for when you're playing the long-term treasury bond, you must be willing to accept that treasury bonds, interest rates change over time. You just have to set a minimum and say, like personal, I say, below 12%, I'm out. It has never been below 12%, but I'm up. I will keep doing that. It has never been below 12%. It has never been below 14%. So that is where you have to do it. For the question of someone asked me, when you buy bonds, you get a holding statement like this. This is for one of the banks. Every time you buy a bond, it will have a structure that which bond do you have, when does it mature? Which bond do you have, when does it mature? So if you wake up and you have, let's say, 10 bonds, automatically it will look like, and it will be on Bank of Uganda header. So when you buy a bond the first time, you can ask it from your bank. They will give it to you. Every time you buy a bond, you keep on asking it. The system will take away all this and it will be in position to direct you. The same way you log in on your app and say and see the bank account, bank details, and say, okay, I have 50 million on the bank. It's the same way it's going to be. No? Straightforward. So you do not need to worry about that. Someone who has asked, Danading talked about, how do you deposit money? Conrad buying bonds is active. If you decide to buy money bond from the Bank of Uganda directly, they sell bonds every single month. Right now, it's too much paperwork. So you still have to feed in a paperwork and take it to your bank or send it to them every time you have money. Next year, hopefully, the Bank of Uganda, that's what they are saying. It's going to be a system where you just log in on the system and do it and buy. But you still have to, it's an active engagement. Fiona, deductions. Simon, I'm coming to you. Deductions, it's only withholding tax. Bonds that are, I'll write it here, have different tenors. Let me call it tenors. We have 2 years, 3 years, 5 years, 10 years, 15 years, and 20 years in Uganda. The 2-year bond have a 20% withholding tax. Same here. Same here. Then 10%, 10%, 10%. Also the bills, treasury bills also have 20%. So this is the biggest cost factor. So when you are buying a treasury bond, you have to ask yourself, if I'm buying a 3-year bond, I now must pay 20%. If I'm buying a 10-year bond, I'm buying 10% withholding tax. That's why even your decision to ladder might force you to buy a 3-year bond, knowing you are paying a lot more tax than buying a 20-year bond when you are paying a 10-year, a 10% tax. Very, very important. The other cost which is important is, and which will answer also Simon's question, is if you are buying from the primary market, your custody bank will charge you a 20, I think it's 23,000. It's to facilitate, it has done work, man. This is their work. They are facilitating, you're going to send them a form. They have to have money power that is going to get your form, fill it up in the system, make sure there are no errors, check it up, and buy for your bond from Bank of Uganda, because you cannot go to Bank of Uganda directly. So if you are in housing finance, Stanbic, whichever bank you are in, they will charge you this 23,000. The good and the bad thing of it, the 23,000, whether you are buying a bond of 10 million, 50 million, 200 million, they will just charge you 23,000, even if you are buying a bond of 100,000. Now, for someone who is buying a bond of 100,000, it makes no sense to buy from the primary market because this cost is high. An article is coming about on that in next month, I think on 12th. I just need to do a final checks and balances. So what do you do for 100,000? You buy in the secondary market. In the secondary market, they don't charge you this. They will just make a profit of your bond. So for example, if you are buying a 200K, they will just come and they say, you want a bond of 200K, okay, that's 2 million. And then they say, okay, for them, they bought it at 17.5. Then they'll say, we're selling it to you at 15.5. So then they'll tell you, you just pay 205. So the actual cost will be just this 5,000 they would have made you pay, but you'll get your bond. So what I tell people, I've come to realize that anyone who is investing in a bond of less than 500K, you are better off buying from the secondary market. You end up avoiding this 223,000. It's much better. Yet, if you are buying for 1 million, 2 million and above, you automatically go and buy from the primary market. The 23K is not that much. To repeat on yield to maturity and coupons, Let me come back to that. So I silenced someone. I didn't know who it was who wanted to ask a question. You can ask it now. Yeah.
Hey, so what I wanted to know is I've been buying, but mostly I've been doing the secondary market, and I've been usually targeting the one with the high coupon, especially the one of 2042, the one of 18.5. So what I wanted to know is I really wanted you to. I had like three questions. One, I wanted you to clearly explain clean price. There is what they call dirty price, how they come about it, and then also how you use the the yield to maturity keeps changing. So if I'm buying from the secondary market, how can I use it to my advantage to go and negotiate so that I can get a good deal?
A good deal, yeah.
Yeah,
Okay.
and then also if I'm buying, let's say I want to get a good deal. How do I move? Let's say if I compare when I go to the website of Bank of Uganda and I check the rates that are prevailing in the secondary market. So if I want to buy, do I have to go to, I want to negotiate a good deal. So do I walk to all banks and try to negotiate? And then I compare the one with the best rates. Like, how do you negotiate? Then you get
let me start.
Yes.
Yeah, let me start with that, the last one. You can do that, it's tedious, or you can get an investment advisor that always negotiate for you. So of course, for us, we can easily see the price right away. Bank of Uganda is a day or 2 days behind by the time they publish. For us, you can see that, oh, that's the rate that is going on is 16.3. Automatically, I can easily call the guys. I'm like, okay, I have 100 million, a client of 100 million. I see the last trade is 16.3. I'm not taking anything 16.2. I send that in our group, and one bytes or 2 bytes, and in 30 minutes, you have a transaction. That's why it's important to get, especially people who are investing 50 million and above. I holistically advise to get advisors. You're going to pay him 400K, 500K. They might easily make sure you are not overpaying a price of maybe 5, 6, if they're going to save you money. Of the question of someone asked the yield to maturity versus coupons, which will come into the data price. A coupon is set the day the bond is first sold. That never changes in the lifetime of the bond. So for the 20-year bond is the 15%. It never changes. The yield to maturity, or what we call interest rate. Yield to maturity it's a financial terminology, which is like the discounting of all the cash flows, what the value of that cash flows are right now, depending on. So let's just call it interest rate, straightforward. Actually, in more countries, they call it interest rate, not even yield to maturity. That one changes every single day, not even a day, every single hour. I can easily go to the bank right now, and they give me a quote of 16%. I go 2 hours later, they give me 16.2 or 15.8. That one changes every single hour, depending. There are times when they have too much stock, or someone comes in and they say, right now we are having an influx of institutional investors from Asia. Those guys are going to come and they say, I want a bond of 50 billion. When that deal comes in through the system, the CSD system, and Bloomberg picks it up, rates fall right away, because now the means people are going to sell off and they don't have so much stock to sell. Or when it's done a day later and no one is coming to bring in a deal of 20 billion, then rates go up because now they want to dispose of their stock. It's like a market like that. It's a crazy market, by the way, in the system. It's uninteresting, but a crazy market. So those change. So the yield, the interest rate, is what determines the actual price. Which comes back to the question of what someone asked, the clean price and data price. The clean price, when you're buying a bond, when you are buying a bond, you buy it at a point in time. There is 2 things we always track. When is it next paying a coupon? We know bonds pay a coupon every 182 days. So if you buy it on day 0, it means you'll get the first coupon in 182 days. But if you buy it on a day 100, it means you're going to get a coupon in 82 days. Right? Now, the clean price is the assessment of the bond on day 0. When there is no interest in that bond, there is no accrued interest. It has not yet paid any interest yet. The data price, it assumes that bond has accrued some interest that it is soon about to pay. Let's use the decent bond. It came out at 17.5. So someone bought 100 million worth of bonds. They paid 92 million. But this 100 million is about to give them a 6.75 million worth of coupon in 40 days from now. Have they earned all that, say, 6.7 million? No. They have not earned the 5.7 million because the bond has been accumulating that coupon income for the last 140 days, and it's about to pay it out to them. So what it assumes is the data price you have paid, okay, the price you have paid, it is inclusive of some bond, some coupon. Now this is going to get a little bit technical. It's inclusive of some coupon that you have not incurred, but you're about to earn. The clearing price doesn't include anything. So every time you are buying a bond, do not care about the clearing price. Don't never look at it. It doesn't matter. Look at the data price. And what determines the data price is the yield to maturity. Now you talked about you have been buying these 18.5. And most times they come out at 15%. That's why you end up buying it at 128 million, paying 28 million more than the actual bond. Why? Because they know sentimentally people think buying a higher coupon bond is a good thing. No. Especially if you're buying it at a very lower interest rate. So because people think that it's a sentimental thing, even those who have them price them higher on the secondary market. You are better off buying a 15% at 16.5%. Because why? You can see. For you, you bought 18.5 and paid 28 million that you're not going to get back for the next 2 years. It will take you 1.5 years before you get back that money. Yet me, I'm going to buy for 15%, get a discount right away of 3 million, and right away start earning. That's why it's important to pay attention to the interest rate.
Can I interject?
And yeah.
And if you're to compare, let's say one who is buying of 18.5, 18.5, if you let's say withholding tax, that is 10%, it comes to 16 point something, 16.65.
Yeah.
The net return after lessing withholding tax. So if you're to compare that two, this one has bought it at a discount, but me, I've bought it on the secondary market and I'm paying a premium. So if you're to compute the return, who earns more? Like, fine, I'll pay a coupon. Doesn't the other one earn more in the long run? Because the one of, let's say 15%, if you less withholding tax, maybe it can come to like 13 point something. So the other one has 16 point something. So he has that 3% more than you. So if you to compute it in over the years to maturity, isn't it like more?
Okay, let me do it this way for you to see it, right? So let's assume you are the benchmark. You are the benchmark who 100 million, you're paying 128 million, right? So let's equalize it and say everyone has 128 million. This one is going to get a bond of 140, I think. Yeah. So for you, you are getting a net return of what? 8.3 is getting a net return of what? 9.4. Does that answer your question? I don't know if you have understood what I've done.
I haven't understood. Maybe you clarify more.
I've bought it at 18. You have bought an 18.5 bond.
Yes.
But its interest rate right now is around 15%, right? So you're going to pay 128 million.
Yes.
And you're going to get just 100 million of bonds.
Yes.
So you're going to be getting 8.3 million, which is a lot of money. But let's assume we have two people, they both have 128 million. So for you, you have bought this one, and you're going to be getting 8.3. Then I get person B, I give them 128 to buy that of 15%. Because they are buying it at a discount, they're going to get 140 million, not 100. And you can see they are getting 9.4, while you are getting 8.3. Yes, for you, your coupon is high, but the yield, the interest rate is so low. Yet for them, their coupon is low, but the interest rate is high. That's why I said at the beginning, pay attention to no coupon. It's not what that matters. It's the interest rate. It determines everything. I know we have a few minutes to go. Assumpta, are there any other advantages between primary and secondary market other than except if someone has more than 200 million, you cannot buy from the primary market, you can buy from the secondary market. The secondary market is where you can sell a bond, because we talk about bonds from an investment for long term, but maybe in 2-3 years you might want to sell. You can sell your bond in less than 2 hours, by the way. No one should ever tell you that you cannot sell your bond, that they're illiquid. No. When we come back to this, and that's why I say, especially if you have an advisor, they can easily come in here and they say, what is the price? The price yesterday of this bond was between 100 to 102. So when I go to the bank, I'm your advisor, I go to the bank and I say, I have this bond of mine. The price I see is 100 to 102. I want is 101. Boom.
Okay.
If they agree, we sign a form and you have your money in less than 4 hours. Yes, please.
Can I interject again?
Yeah.
If you look at the prevailing markets now, for example, now the current, let's say now that that same bond of 18.5, it's a 20-year bond. So right now the interest rate, the yield to maturity for the last auction was 17.5, right? So when I go to buy it on the secondary market, when I'm negotiating for the yield to maturity, the bank may say I'm going to give you at 16, but then I say, look, the secondary market, the last bond that was bought, that was auctioned for 20 years, what the yield was 17.5. So can't I use that as my bargaining power also? And I say, I want it, but I want it maybe, I want at 17.3.
Yes and no. Yes, every time Bank of Uganda sells a bond, it automatically, the new interest rate automatically prices all the other bonds automatically. So you can use it. No, because they are different bonds. You see, different bonds have different demands and supply. The new bond that has been sold, the 20-year bond, has now a 600 billion supply capacity in the new market. That last bond no longer has any supply. You get my point? So in actual sense, even if it's me negotiating for you, when I go to the bank, they say, no, Alex, that bond, right now I have 100 billion worth of that bonds. It's never coming back on the market. So I cannot take away this money. If I'm to let this go, the closest I can give is 15.5 or 16. Yet if you say, okay, what about this one they have just sold? You're like, this one I've just got new supply. That one I'll give you at 17. Think about it this way. When you go to buy clothes, and now there is a new designer shirt and the old designer shirt, or even the phones. When you go to buy iPhone 13, if it was at 2.5, some have. Now I have so much of this stock. 2.3, it's not so much on demand. I'll give it to you at 2 million. But iPhone 16 is limited in the supply. And people want it so much. If you don't have 6 million, I will not give it to you. So in the bonds, it's the other way around. Bonds that Bank of Uganda has stopped selling and of which had a good rate when they were first sold. Those who have them don't want to sell them. That's why for them, they will always be at a premium. Yet the bonds which Bank of Uganda is selling, like this new 20-year bond, a banker is willing to sell it to even at 17.2 or even 16.8, knowing fully well in Jan they will buy it back because the Bank of Uganda is going to sell it in Jan, it will sell it in March, it will sell it in May. The new 15-year bond, they are selling in December, they know they can sell it in February. So even if they sell it to you, they know they can recoup it back. The 18.5 bond, they can no longer recoup it back.
So do you mean that? Sorry for interjecting. Do you mean that
no,
now,
it's okay.
If I want to sell it, if I buy it now, let's say I've held it for 3 years, I want to sell it, it will be, do you mean it will be a little hard to sell it? Or I will sell it at a loss?
For you, it will be easier for you to sell it and you sell it at a premium. You get more money. It's on demand and the supply is so low. So anyone who's the one people, let's talk about that bond actually. For those of you who don't know what the bond is talking about, let me show it to you. It's this bond. Actually, let me use it for demonstration purposes. In 2022, the government was so broke because after the COVID elections, there was no money whatsoever. And government issued a bond of 18.5%. There are few people who managed to get that bond right now. Let me show it to you. There are some factors I'm going to show it to you. They issued a total of 1.23 billion, 2 trillion. It was in a space of like 6 months. Then they discontinued it at a coupon of 18.5, and actually even the interest rate at that time were very, very high. The people who bought it, they bought it at that time, they are getting really good coupons for the next 20 years till 2040. Those who have that bond do not want to let it go. Whether they are banks, whether they are institutions, they do not want to let it go. The only time they want it to sell it to you is if they are selling it cheaply, expensively. If you are paying them a coupon, that if you want to get it for 100 million, they will tell you, if you do not have 120 million, I will not sell it to you. Because they know how valuable it is. It's the highest coupon rated bond. And the issue is, Bank of Uganda discontinued it. It understood the impact of it and it stopped selling it. So for those of you who have it, or for the people who have it, if they are to sell it, they will sell it quickly and the bank will give you more money than the worth of the bond because they know people demand it and it's in short supply because it was discontinued. Yet, if you are to compare it with the new 20-year bond, because they know Bank of Uganda is still selling it, so far they have issued it, the new 20-year bond is this of 15% on demonstration. Remember this 1.3 trillion? This one is in 3.2. So think about it. All of these two bonds are 20-year bonds. They are categorized as long-term bonds. One is 1.2. It was capped, discontinued. Very few people even know about it. This one, they have so far issued 3.2, and I don't think it has captured the 600 billion of this week. And it will be sold in Jan, in March, in May. So we can assume by the time this bond, by end of June, they would have sold off close to 4.2 trillion. the supply of this one is so high compared to the other. So the people who have the original 18.5 bond don't want to let it go. So for you who's trying to buy a bond right now, it makes no sense for you to buy a bond that is in high demand and in less supply. And here we're talking about the forces of demand and supply. You are better off buying a bond which is in too much supply and in less demand. That's why you make the money. That's why you are seeing the interest rates on such bonds are higher. I don't know if it makes sense to you. I was been asking me this question.
Yeah, it makes sense. And then lastly,
Yeah.
how do we buy from the, let's say I want to invest in the Kenyan markets. Are we allowed to, as Ugandans, can I buy a bond in Kenya?
You can, if you can do these three things. In Kenya, it's in Uganda here, you can buy a bond. All you need to buy a bond is a bank account. In Kenya, to buy a bond, you must have a TIN number. It's the hardest thing to get in Kenya if you are not a Kenyan resident or a citizen. So you need to travel to Kenya, register, get a TIN number, or I know there are tax guys who are now trying to offer that service. When you get that, then you can open up a bank account. You can invest, because in Kenya you can invest online. It's a door. You no longer need to. So the hardest point is about that. Isaac, you raised the question. I think you might have a question. Innocent,
yes,
what are your thoughts
Alex.
on the? Go on.
Yes, Alex. I had two questions. One of them is related to what you just answered, and I don't think you completed it. You said three things. One, you mentioned TIN number being one of them. I don't know what the other two are, but before you respond to that, you mentioned the point where you said if somebody does not have a lump sum and they want to maybe dedicate a certain amount of money every month, say, you used an example of 300,000. I just wanted to understand, if a bond is issued, if it's the 300,000, am I buying, if I do that every month, am I still buying towards this a specific bond, or I'll be holding different certificates in 300, different certificates of 300,000? Please highlight that a bit more.
Okay. On the first question, for the Kenyan bond, you need a TIN, you need a bank account, and you need to understand the Kenyan market. Those are the three things.
Okay.
But the good thing these days with the Kenyan market, when you can get a bank account and a TIN, you no longer need to go to the bank. You like take a physical form, you buy directly from, they have a system which Uganda is trying to replicate. Of bond, when you have less money and you're trying to invest, right? Let me put it this way. Each bond gets sold at a minimum for 2 years on the primary market. So that means if you have 300K, you have for 2 years, that's the 3.6. No, 300K, that's what? Forgive me. Yeah, 3.6 a year, 7.2 a year. So you have 7.2, you can easily buy one bond. Then that one gets discontinued, they bring another bond, you continue like that. But let's assume you want to buy just one bond. You just have to continue going to the bank and buy that bond from the primary, secondary market. They will always give it to you. So you'll have one certificate, it will have one bond. But I know when you dedicate to invest in bonds for, let's say, 5-year period, you can never buy just one bond. You just have to keep buying. It's okay to have 20 bonds as long as they make business sense. If you have small money, you are better off to accumulate it in one bond up to, let's say, 5 million. Then you move to another, like that. I know I have like 3 minutes for the 15 minutes they asked. This, it can't end.
Hi, Alex. I wanted to ask.
Yes.
I wanted to ask a few questions.
Yeah.
Could you, I know this is really dependent on the individual. Could you give us, out of my overall portfolio, let's assume it's 100 million. How much is a safe percentage for things like ETFs, if someone is to venture into that area?
Okay.
I don't know if I should ask at once or I ask one by one.
Ask at once. I'm writing.
Okay. The second question is about real estate. You've always talked about the challenges in that market and the low returns for renters, but I believe it's also an important part of an individual's portfolio. If you could also advise for someone, let's say in their mid-30s, who is wants to grow wealth, how can we incorporate real estate realistically without losing too much money, but also spreading the risk? My next question is unit trusts. I see in the Kenyan market, there are funds like Mansa X and funds like Ndovo that have exciting rates like 18%, 17%, 17.5%. Is this because of the underlying assets, the rate of return, or why is it that we have these exciting rates in Kenya and not in the Ugandan market? And is there a hope for our unit trust rates to get more, to get better with time?
All right. Let me start with the last one. Okay.
Let me just add one more, please. You talked about investing in money markets through unit trusts. I don't know what they call them. Do they call them those equity funds like in Zeno? I think Zeno has one where you can go and buy a product that invests in the securities market.